83% of companies in America that are doing 100 million or more in revenue are privately traded right
Hmm.
now. They're
Wow.
privately held, not publicly available. 100 million is a decent sized threshold. And if you think
Right.
about it, that the largest air conditioning repair company in a major top 25 city is probably doing 100 million in revenue now, but none of these are publicly traded anymore. And I just told you that Amazon went public at less than 50 million in revenue.
Right. That's crazy.
So
Crazy.
you got to shift where you're investing to match like where the markets are today.
Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with you, we're investing in over 1,000 multifamily apartments under renovation, nearly 100 single-family rental homes under development, more than 350,000 square foot of industrial real estate, $700,000 of private loans, and nearly 40 oil and gas wells. And we've expanded to other asset classes with the end goal of helping you, our investors, create diversified, balanced portfolios. Before we begin, as always, a quick disclaimer. We're not financial advisors. Our guest is a financial advisor. All investments are subject to risks, including the possible loss of the money you invest. So please perform your due diligence before making any financial decisions. And of course, consult your CPA, your attorney before beginning investments. I'm your host, John Lai, and welcome to today's episode, Protecting Your Capital in Private Investments, Leverage, Risk, and Costly Mistakes to Avoid with Henry Yoshida. Henry is the CEO and co-founder of Rocket Dollar. He's former founder of Honest Dollar, which was acquired by Goldman Sachs, 10-year Merrill Lynch veteran. Henry is here to break down risk management principles for sophisticated investors before deploying leverage in private investments. Some of the things we'll discuss today include how leverage really behaves inside private deals, the common funding mistakes investors make, how to think defensively about committing capital, and so on and so forth. And today, we'll learn how experienced investors protect their capital, structure funding properly, and avoid mistakes that quietly destroy returns. For those who don't know your journey, Henry, could you give our audience a brief history of how you got to where you are today?
Yes, John, we were talking about this. I'm based in Austin, Texas, and I went down a path that wasn't really planned for me. I ended up taking a job out of college at Merrill Lynch to save up money to go to grad school. I wanted to go to law school, but I never went. I started at Merrill Lynch in the year 2000, so it was right when the internet bubble was bursting. So a lot of companies that people in our audience here might be familiar with from back in the day, those companies weren't doing too well if they were publicly traded in the year 2000. So for me to survive at Merrill Lynch, I ended up sort of coming into this niche of setting up and consulting on small business 401k plans. And I've just kind of stuck with tax advantaged retirement accounts. So I developed a very different investment philosophy than someone who maybe came up in the financial services industry just recommending investments. Like, in other words, they were always espousing their opinion of what to invest in. And my entire lens of investment strategy actually became where you have your investments. So that became tax advantaged accounts because dollar for dollar, whatever you did your diligence and decided to invest in, if you owned it in a more tax efficient structure, then you were going to make a better return dollar for dollar having that same investment in a non-protected account. So it was really different. So people talk about asset selection, but I was more of an asset location type person, which is very, not very popular stance. And then throughout those years, 10 years at Merrill Lynch, 2 years of it was owned by Bank of America, then split off, took my group with me. We did management consulting, set up a consulting shop. We sold that. That's when I started the company, a small digital wealth app advisor, which was acquired by Goldman Sachs. And then in 2018, there was a shift that kind of aligns with what you guys do at Clive Capital, you, Keshav, and your team, where I just saw that there was this growing demand among my friends, among my professional circle, interest in private and alternative investments. And this was around 2018. And again, sort of always having a different lens of how to look at the world, I decided not to try to create a product to democratize access to alternative investments, but actually focused on the other side of the equation, which was where does the capital come from a average American retail investor to go into these investments? And there were not a lot of people focusing on that side. And that's how Rocket Dollar came to be, which is effectively a self-directed IRA platform, which means that I help people unlock the money they have in 401ks and IRA accounts, keep the same tax treatments, but instead of stocks, bonds, and mutual funds, they can go into private and alternative investments similar to what you guys offer at Clive
Yeah,
Capital.
that's great. Wonderful story. And I love the timeline. I spent a little bit of time in TMT banking in New York. And so I understand some of what you went through in your journey as well.
Yeah.
So I'd love to understand a little bit more about capital protection. I know what you do today is really focused on self-directed IRAs, self-directed 401ks and IRAs.
Hmm.
I know a lot of our investors would appreciate that. They'd also like to utilize some leverage in private investments. And by leverage, I mean, and maybe you can define what that leverage might be, but I know personally using HELOCs, using S blocks to provide leverage, provide capital to invest in private investments. That's a thing, right? And
Hmm.
so I'd love to get your perspective on that as well.
Yeah, and everything I'll speak about is from the lens of probably tapping into these accounts that most people, and this isn't just, let's say high earners who work at technology companies, W-2 employee types, but throughout the years since 2018, and even myself before I started Rocket Dollar, I wasn't aware that IRA and 401k dollars could actually be used to go into private and alternative investments. I only found out because I stumbled across a 2012 Wall Street Journal article that was then chronicling some people, some tech titans like Peter Thiel, Max Levchin, who was the CTO of PayPal, went on to found Affirm, probably the more recent company he's done now, the buy now, pay later company. And then it also chronicled people like Mitt Romney, who was a presidential candidate back in the day, having these outsized IRAs. So when you talk about maybe folks being able to access the home equity as a line of credit against their property, I think about it more that people can tap into a money and asset source that they currently have, which is already earmarked for long-term investment purposes, but use it to go into a new type of investment. So non-stock, non-bond, non-mutual fund type investment. So my maybe the ability to use leverage is to go and activate a asset that people already have and utilize it in a different way because in tax advantaged accounts you actually can't borrow against those. So my capital preservation perspective and lens might be slightly different than what you typically think of when you say leverage, which is use some percentage of equity to borrow at an interest rate and then try to invest in something at a higher rate of return and keep the spread as an
Right, right.
example. So I'll speak about it from a different perspective, but it's really because the laws don't allow leverage the way we know it in the form of borrowing money inside of these tax advantage accounts. But I say leverage in that people always say that, well, I don't have liquid capital to go do this particular investment when I get approached to go do a real estate deal. But this is someone who may also have $750,000 in old 401ks, which are now in an IRA at Fidelity, sitting in three index funds and in four tech stocks, for example.
Right. Now, is there some, I guess, considerations in terms of how they can leverage retirement funds, whether it's 401k, whether it's an IRA, in investing in private equity? I know there are prohibited transactions, certainly,
Mhm.
but are there other considerations that you would counsel your prospective investors when they're leveraging those 401ks, those IRA accounts?
Sure. Well, one of the best things to do is actually to go in and invest with a syndicator or someone who appropriates funds in a cluster. Because if you're a passive investor in a private equity fund, or let's say a syndication, which is going to be used to purchase a multifamily real estate project, I'll just use that as an example. If the particular deal sponsor, so in this case, it could be an organization like yours, chooses to use leverage to be able to buy a $10 million property with $5 million down, for example, some of which would be coming from the syndication investors, the LPs. In that case, any investor using an IRA, because they're passive in that deal, is able to participate even though the deal itself is using leverage. So you're not the one directly using that leverage. So that I actually tell people that the syndication does a couple things, and we're going to get into that. But since one of the topics is capital preservation and or minimizing risks, it's that by going into these syndications, you can do many more deals as opposed to doing one big deal on your own with 50% of your old $750,000 in old 401ks. That'd be risky. And then if you did that by yourself and you were also running that deal, you would not have the ability to borrow any money. So let's say you did 375,000, half of that, half of the 750, you would only be able to purchase a property for $375,000, and that's probably not going to allow you to get a multifamily project. But if you did, let's say, 5 deals for $50,000 each, or 6 deals for $50,000 each, you would deploy $300,000, less than 375, so not even half of your account, and you'd be able to do six $50,000 units into different deals. And 4 of those deals may be in real estate, 2 maybe in oil and gas, and all of them at the deal sponsor level could be using leverage. So you're kind of amplifying your money, spreading out the risk somewhat into different particular deals. And in any one deal, you don't have more than $50,000. And the reason why that's important is that I don't think about deals going into them as like a complete loss of capital type of situation, but I do think about it as maybe the more realistic scenario, because the reality is that a small percentage, a very small percentage of deals may go completely away in terms of your 50,000 goes to zero. So the more likely scenario is that you probably want to stack the way the income streams come in or the returns or the lockup periods. That may be a better way to look at capital preservation and spreading out the risk, in that you might do 3 deals that have no preferred income stream or no passive income stream in the beginning and only a payout at the end. And then 3 additional deals which have a constant income stream with a partial payout if the property or the project is completely sold at the end. So now you're staggering the way you receive money in the form of cash flow back into your IRA in this case with Rocket Dollar. So I think people need to understand those dimensions and think about capital preservation more from that perspective and less on the less likelihood chance that your deal goes from 50,000 to zero.
Right. That's interesting. I never really thought of for self-directed accounts that staggering staggering these investments is important, because I've always thought, retirement accounts, you're not going to touch it until 10 years down the line. But with
You're
a
not,
number
but
of
you
these
may want to go into
investments,
different deals, right? So
correct.
different vintages of
Correct.
deals, right? So that's
Yeah.
the reason why is that if you have different payout streams coming and maybe different lockup periods, it will put you in a position to, right now, I would say it's probably a 50-50 toss up that if you were to ask, 10 economists, you'll get 14 answers. 7 of them will say that it's a great time to buy in the real estate markets, and
Right.
7 of them will say that it's not. Because, and the reason why is because, 4 to 6 of those people gave an answer on both sides of the fence, and they weren't willing to commit to one or the other. So that being the case, really, all joking aside, it just means that no one really knows what the right time is. So even though it's in a somewhat illiquid account that you can't access for consumer discretionary purposes, you do probably want to have cash available to be able to act on opportunities, because what if 2026 actually isn't the bottom and 2027 presents better buying opportunities? Because the reality is that if we look at the headlines, they all get recycled. I would venture to guess that a lot of people saw notes saying that 2023 or 2024 coming, 1 and 2 and 3 years post like pandemic and COVID were great times to invest. But it actually turns out that, maybe being a little more patient, particular to real estate, might actually be a better opportunity now because rates have stayed very, very high, which have kept prices depressed and low. So for a cash type investor, there's opportunities to be had. Hence people like yourselves who are pulling capital are able to get better deals in 26 than they were in 25 and better deals in 25 than they were in 24. But, at the end of the day, you probably made deals and you made investments each of those years thinking it was the right time to buy.
Right. Right. How do investors utilizing these self-directed entities do so efficiently? Are there tax strategies that they should keep in mind?
Well, in a way, it's a little bit simplified because at the end of the day, if you make private investments in real estate, let's say, for example, using just regular taxable money, then you would work with your tax advisor and they'd help you sort of offset expenses, look at depreciation and so forth. So there's I would say a different flavor of tax advantages there that maybe require a little bit more manual work and or professional outside help. Whereas if you do this inside of an IRA that is capable of investing in alternatives like the ones we offer at Rocket Dollar, then you're really just thinking about it from the perspective of I'm making an investment into this particular deal, the syndication, and so forth. And any income stream that comes out will not be taxed to me as ordinary income. So you're just simplifying it. In other words, it's no different. I tell people the analogy is that, we were talking Europe in the Northwest. So I'll use an example of a technology company publicly traded that does pay a dividend. Let's say Microsoft, for example. So if you own Microsoft inside of your IRA, well, the dividend, when it comes back, is just additional cash that you don't have to pay an income stream on. But if you own Microsoft in your brokerage account and it pays a dividend, you'd probably want to ensure that that dividend is a qualified dividend because then it would qualify for a lower tax rate. So a little more manual work, just a different flavor of a tax advantage. So I'd say that maybe it's a little less complex in that anything you invest in using IRA dollars, whether it's a stock like Microsoft that pays a dividend or a real estate project that's paying out a 10% rate of return until the property or the project is completely sold, at which point a pro rata distribution will go out to every holder of the investment units. That at that standpoint, you really only have to worry that you're putting in tax deferred dollars. You don't have to worry about any of it hitting ordinary income. And whatever that account grows to overall, you're only going to pay taxes if and when you take out the money post 59 and a half, similar to the rules you're familiar with in an IRA. And I know I'm talking kind of fast about those rules, but what people need to understand is that an IRA is the same whether it has alternatives or traditional investments. So the rules that you may know, and for most people, and probably in this audience, they're somewhat ubiquitous and generally understood. They would apply the exact same way, whether you own Microsoft paying a dividend or whether you owned a rental property paying a rent stream
Right, right.
inside.
Um, is I and I forget the rules, but in IRAs and 401ks, are there stepped up bases if I, as the investor, pass away and leave my assets to the decedents?
There's actually sort of better rules for that because the person who inherits the IRA. So whoever you list as a beneficiary actually inherits that IRA and continues the tax advantage treatment for up to 10 years. So they get a chance to
Right.
do that for another 10 years. It used to be forever, but they changed that about 5 to 7 years ago to where now it could only be extended for 10 years. And used to have strategies, and this would be going down a wormhole where people are actually skipping a generation and naming more their grandchildren if they were in their 70s as the beneficiary of the IRA because then if something happened to the person at 80, that grandchild might then be in their 20s. They'd be able to hold that account from 20 to basically 70, 72,
Right.
74 until they had to start taking money out and continue to defer those taxes. So they don't do that anymore. It's only for 10 years. So it's not quite a step up in basis, but the ability to continue growing money without paying taxes is given to the person who inherits that IRA. Again, different flavor of tax advantages versus, owning it outright inside of a brokerage account.
Got it. Okay. Could you talk about maybe some gotchas? Like I know that investing through self-directed accounts into a leveraged investment may trigger UBIT unless you're utilizing some specific type of retirement account, like I believe self-directed
Yeah.
solo 401ks don't don't have the same UBIT restrictions. Could you talk a little bit
It,
about that?
Sure, it could. So UBIT, we'll define that term. So unrelated business income. So if the project you invest in does utilize leverage in certain ways, it could kick off an amount that would be taxable. And again, with your tax advisor, you would generate a form, the deal sponsors would generate a form, and it'd be determined after the fact if there was some portion of the income that could be taxable. But the rest of that investment and the part of the income that wasn't unrelated business income due to leverage or some other reason would continue to be tax shielded. So yeah, I tell people that that is not a reason to not do investments that would utilize leverage using your IRA because it's a percentage. It's a percentage of it. So I'll use actual numbers. Let's say you invest $100,000 into a passive deal as a passive investor. And it turns out that the way that deal was structured, it's supposed to pay out 10%, but 2% of that 10% is considered UBIT. So you should still do the deal because you're going to get $8,000 a year in income that is able to continue to be recycled and deferred inside of that account. And then you would be, liable to pay taxes on $2,000 of income. So it's partial. So in other words, like I try to tell people because I've heard everything, across our customer base or just, kind of doing shows like this, people have said, well, you don't want to own any of those things inside of these accounts because you could generate UBIT. But again, it depends on how the deal is structured. And in my experience, I've found that relatively few deals actually generate UBIT that does go back to the end shareholder. And one of the
Okay.
best ways to do that is the way to minimize it by far is by doing passive deals where you're just passively, allocating 25,000 or 50,000 or 100,000. In other words, it's not you putting up all 375,000, which is 50% of our hypothetical $750,000 401k, and doing one property of your own, at which point then you're the deal runner. So you're not passive in that deal, you're active in that deal somewhat. So you have a higher likelihood that some of that may be excluded from tax deferral and tax advantages as we know it inside of an IRA.
So the classification between passive and active, that is what I'm hearing is that is important in terms of how it's classified, how the income is classified.
I just think it's kind of a better way to do it. And again, the reason why is not actually because of you would have the best chance of avoiding UBIT. That's a minor reason. I would say the
Right.
biggest reason why is because you'd be able to do six deals at 50,000 instead of one
I
deal
see.
at
Right.
375 with more
Right.
capital out of pocket and more risk. And at the end of the day, what I found is that most people who are self-directed IRA investors, the reason why they have that kind of capital inside of an IRA to open up one that can, with a portion of their monies and do alternatives, is because they have a job source, let's say a high-paying W-2 that allows them to max fund a 401k. And as they move from, let's say, company to company, the old company 401k becomes eligible to roll to an IRA. So I guess my point, to be more succinct about it, is that you typically have your day job, then you have your life, which includes your family and living your life outside of your job. And then last, you're an investor trying to make returns to give yourself a sustainable retirement nest egg properly diversified. And that goes to maybe again preserving capital and limiting risk, which is that now for someone to probably get properly diversified, it's not really relevant for them to do a 60% stocks and 40% bond type of portfolio because they're very correlated to each other, even though they're both publicly traded. So it might make more sense now to have a split between 50% in public equity type investments as well as 50% in private type investments.
Got it. Got it. Got it. If I were an investor and I had taxable balance with, one of the big providers and then, had a self-directed account, how should I go about thinking allocation of my assets into different investments?
So I do tell people that you probably want your investments. So there's two sides of it. It's a barbell. Okay. So on both sides of the barbell is where you should have probably your investments inside of an IRA. So one side of that barbell are investments that kick off a lot of income because you're a high income earner. So anytime you earn income, it just gets added to the high income you already earn, at which point you get taxed more on a marginal basis for that income. Okay. If you're a W-2 employee, if you're a business owner, maybe it's a little bit different. You can work with your advisor and do things. But so that's one side. Pays off a lot of income, probably want to own it inside of an IRA. On the other side is that potentially there could be a tremendously high down the road rate of return on top of the principal that you have. So the far other end of the spectrum. And then the things you own in between are probably best owned in a taxable account, which is a little more predictable. You know the base, or it's an individual stock, and you plan on never selling that stock, so you would get that stepped up in basis if you were to die. But most people try not to focus on those types of things. They're 45, thinking of what may happen to them at the age of 85 or 95. But
Right.
but to make it simple, I would say that you look at this barbell approach, which is that if you're going to do a $100,000 investment that is going to kick off a 10% preferred yield in the form of income, that's not a good type of investment to hold inside of your taxable account because now you just added 10,000 in income at, let's say, maybe a marginal tax bracket of 33.4%, if you're a $350,000 base salary earner at a company, for example. Doesn't make sense to own that because your $10,000 income stream is really now effectively only 68,000 and so forth. So, but on the other side of the spectrum, if you are making angel investments into early stage technology companies and you develop a portfolio using your IRA monies to go into five, six, seven, 10 of those types of things, the hope would be that one of those is an outside return and returns 25x your initial principal. that also you would not probably want to own in your taxable regular brokerage account as well, or using cash outside of an IRA. So those two sides of the spectrum, maybe the more predictable type stuff is in between in the taxable brokerage account, I would say.
Got it. Got it. Thank you for that. If I am a W-2 worker, but I'm thinking about retiring sometime soon, or maybe I'm already retired and I have a mix of my taxable accounts as well as my retirement accounts, and I need to access more capital, these are retirement accounts, but is there a way to access that capital within retirement accounts? I know Roth conversions and then the Roth basis and so forth, but what are strategies around that?
Well, so if you wanted to access it, but if you were retired and you're a W-2 employee and you retire early, so now you're asking about like, what order of distribution you might do. So again, you started the segment by saying, I am licensed as a financial advisor. I'm a certified financial planner designation. I'm not practicing currently, but if someone were actually retiring early, so this is before the age of 59 and a half, or really 55, there's a thing you can do at 55 to access your IRA accounts, but let's just say 59 and a half or 60 is the real number. But you decide to retire from traditional day-to-day working at the age of 49 or 50, for example. I would actually advise those people to start taking distributions and decumulating and living off of the money inside of their taxable accounts before, because they want to actually let the tax deferral keep going, because you can extend that all the way up until the age of 72 and 74, depending on exactly your situation. They do change that from time to time. It used to be 70 and a half, then it became 72, and most recently became 74. And that's the period that you can continue to have investments inside of an IRA account
Hmm.
growing without you being forced to take some money out of it. So if that's the case and you leave at 50, I'd set up someone's plan to make sure that they actually spend out of the buckets of taxable money first and let the non-taxable deferred ones like IRAs and 401ks go as long as possible, because they'll grow to a larger amount. And then as they need to tap in, let's say that the taxable monies start to dwindle down and they don't have enough to cover the amount they need to live off of in a particular year, they can take a controlled amount. Let's say they need to supplement by taking an additional $50,000 out of an IRA or 401k. Well, at that point, let's say presumably this is after 59 and a half, because they've gone through the taxable money from the age of 50 to 59 and a half. They need to supplement now and take 50,000 out of the IRA. Well, that only the amount that's taken out is subject to income taxes at that point. So they may have a $1.5 million IRA slash 401k combined balances. But if they only took 50,000 out that particular year after the age of 15 and a half, they'd only have to pay tax on the 50,000 they took out. The remaining 1.05 million, or the remaining 950,000 if it's $1 million account, will continue to grow tax deferred, whether that's in investments that are kicking off income streams or just ones that are appreciating in absolute value.
Yeah.
That's the strategy I'd tell them. So they need to work and determine what buckets to take money out of first, taxable first, tax deferred last. Let the money work, hardest.
Are there strategies to be able to access that capital before they reach 55 or 59? I've heard like, Roth IRA conversions to be able to take out the basis. Obviously, if you don't need to, you should leave it
Yeah.
in there and let it accrue. But
If you don't need to, you should. But again, I live in Austin, Texas, and I know a lot of the audience that's listening, are people who work at big technology type companies. And I always joke around, and I kind of lightheartedly say that yes, that's one of the strategies, but it's one of the more difficult ones. And I find that this particular audience, they always gravitate towards the more difficult one. The reality is, if you're planning to hang it up at that point, I would tell that person to actually less aggressively invest in these tax deferred accounts to keep building up taxable accounts, because that's a better strategy. Because the moment you do a Roth conversion, you have to pay tax up front anyway. So if you're really just trying to solve for a 5 year gap because you retired at 55, but you could access the money at 60, 59 and a half, or you retired at 50 and you could access that money at 60, you'd be paying tax up front to do that Roth conversion. So you would be out of pocket, putting money, sending cash directly to the IRS to solve a 10-year problem. So the Roth conversion is better if someone is listening to us right now and is actually more in the range of being 35 years old and not thinking about retiring. So the audience is different. But again, jokingly, It's that people love using that term. Like I think like you've asked me, no matter how I answer the question, you're in your head, you're always thinking ahead, John, about Roth conversion. And I would tell people that, look, it's the more difficult one. It's like when someone asks me, like, "Hey, I want to start working out and getting in shape. You know, maybe you could give me some tips and tell me your like workout splits and the exact exercises and weights you do." And I might say that, look, you gravitated towards the most complex answer that I could give you. The reality is that why don't you look at your phone right now and see how many steps on average you take per day based on your Apple Watch and your phone? If it says 5,000, you should just get that number to 8,000, and then we'll talk about weights 2 months from now.
Right.
You know, if you had 60% of that number, you'll probably get in shape a lot more than if I sat down and told you 5 exercises to do.
Yeah, yeah, that makes a whole lot of sense. So you came up through Merrill Lynch, you came up through essentially like the traditional financial world where maybe using retirement accounts in this manner, private equity, investing in private equity wasn't a thing or wasn't really promoted. I think looking back on it, what lessons would you take from your experiences, knowing what you know now versus what, coming out of college and working for
Sure.
Merrill Lynch, what differences have you seen?
Well, it's the market that's evolved, John. So I would say that when I started my career, it actually was the right thing to do to diversify between like fixed income investments and public equity investments. And there's a couple reasons. So I pointed out that I started in the year 2000 for a couple reasons. One, it was when the quote unquote internet bubble was bursting. So there were Y2K concerns. And the stock market did have a very terrible run in 2000, 2001, and 2002, particularly, is actually the year that the S&P 500 went down 22%. I happen to live in a somewhat tech-heavy town in Austin, Texas, so it affected individual people that I was trying to procure as clients and ended up getting me into this niche. Now, at that time, the right diversification strategy would have been to have some portion of your investments in fixed income because rates came down, which meant the value of fixed income and bond investments went up, and you could have held those accounts in traditional providers. Back then, also companies were going public while doing less than 100 million in annual revenue, which doesn't exist today. So, you told me that in your past you were at Amazon. Well, Amazon went public when it was doing roughly 30, 40, 50 million in annual revenue. Amazon today does that much in revenue in the time it took me to say my last 7 words,
Right, right, yeah.
right? But the next Amazon of today, let's say the future big tech companies of tomorrow, the next Magnificent Seven, well, they're already there from a market value and market valuation standpoint, but they're not available to be publicly invested in. So let's think SpaceX and OpenAI, both companies probably on paper and maybe in actuality, both worth $1 trillion each, but they have not offered their shares to the public. So, in other words, these companies don't go public. So, there are no more small cap, micro cap stocks that could sit inside of a Russell 2000 index fund or a VTI Vanguard Total Stock Market Index fund that captures all the stocks in the market. And as an Amazon goes up the ranks from 4,772 all the way up to maybe at its highest point, 4, and back down to where it might be today in the 10 to 25 range from a market valuation standpoint, you didn't get to participate in that anymore. So what happened as I went through my career was that people had to zig because the market zagged, right? These companies were no longer going public to access capital to continue to grow. They were accessing private equity. So for the average retail investor, something needed to change. They needed to shift their strategy. And now bonds are correlated to stocks. So the best way to do that is to find your way to get invested in these private markets. Now, could you do it directly on your own? Not easy to do. But there are folks like yourself who have structured funds, who have friends and family access, who might be pulling capital to become an LP in a venture type fund. And that's how you get access to these private markets now. So really, I wouldn't go back and tell myself in the past anything different. What I was doing then was the right thing. The only difference is that the market had changed, right? So when I started at Merrill Lynch, there were a five-figure number of publicly traded companies. Today, that number is around 3,780, 3,800-ish public companies. So it's 37, 38, 39, 40% of publicly traded companies that existed at the beginning of the century. In that same time period, though, the private markets have absolutely exploded. And I was just at a presentation. They had folks from Stepstone, Vista Equity Partners, Carlyle was there, and so forth. And one of the stats that one of the presenters gave at the beginning in the opening remarks was that And where the markets are today, are companies staying private from idea to open AI and SpaceX market valuations close to $1 trillion.
It's interesting that you bring up AI. I mean, how should investors utilize AI today? I mean, I guess investment is one way, underwriting
Sure.
investments, doing due diligence. But in the context of the retirement account, is that any different than like investing in a taxable account?
Uh,
And I'm talking
well,
about specifically about utilizing AI.
so I don't know if it's specific. I mean, I think that utilizing AI to determine you could start to talk to your AI and maybe get it to give you a sense of, hey, based on my income, partner and I, spouse and I, we both make W-2s. This is what we do. Help me optimize, like, what buckets to go into. Because the thing is, yes, you could probably open up an AI chat with and ask it what stocks it thinks you should buy. But I think the better question, and the one that you'll get a more objective answer to, because these are objective answers that are available as opposed to opinions, would be optimizing like where you allocate your funds. So your next dollar, your next 10,000, your next 25,000, you could actually feed it the rough income ranges or adjusted gross incomes from last year. If you trust it enough, you can actually even upload your actual tax returns plus your current pay stubs and have it tell you, because it can give an objective answer to this of how to allocate to the bucket. And I would even do it on the same thing. So if you are that person who's 45 with a 10-year path to landing the plane and getting out of the workforce by 55, that's before 59 and a half. So you might ask it then that, hey, I don't want to pay a big chunk of money to do a Roth conversion, even though it sounds real cool on Reddit boards. Help me devise a strategy and put money in my buckets, both taxable, IRA between my partner and I, and so forth, and 401k to make sure that I have an income stream so I don't have to tap in and pay an upfront amount or take an early penalty to tap into my 401k and IRA type investments. Like asking those types of questions will give you very, very objective answers because they'd be based on current tax rates. And the only thing it wouldn't know might be the minor changes they would make to those tax rates, which will change. The amounts you can contribute every year will change, but they're not going to change by 300%. They're going to change by, 5 to 15% over
Right.
the next 5 to 7 years.
Right. I wish the various AI tools had access to private investments so
Sure.
that, as you do your research, yeah, you have access to public markets, but per your data point, if that's only call it 30%, 40% of what you could possibly invest in, you're missing out on the bulk, the majority of what you could allocate your investments into. Unfortunately,
Mhm.
it does not, and it only has access to public information,
Right,
unless you feed
right.
it private information.
Yeah, yeah, unless you feed it that. But even then, even if it had private information, I mean, I'm a big believer that even if you had private information or public information, to be fair, anyone listening to this show and myself and you included, even if we were given private information that we think would give us an edge, the private information that we would have access to, someone else would have access to it, and it would
Right.
already get priced in. So
Right.
maybe I'm a little bit cynical when it comes to this, but after 25 years and being in offices at Merrill Lynch and seeing all of these particular investors, kind of espouse like what they think is going to be the next hot thing and be completely wrong, whether it's on television on a day-to-day basis. I just think to myself that, what are the objective things that you could actually act upon? And early on in my career, and what's kind of stuck with me, and this is as someone in my position who's been a certified financial planner designee since 2004. When I did my consulting, my firm had roughly $2.7 billion in assets under management. And the things I learned were that you could objectively lower the cost you pay for the management of those investments. So you could concentrate on expense ratios and you can optimize what buckets, taxable, tax advantage, tax preferred, or straight exposed to taxes that you own. Those are things that are objective that you can control. And they have nothing to do with whether you think one particular stock is going to go up or down based on what's happening in the world, even if you had private information
Hmm. Right.
about that stock.
I like that. I like that. I think we're getting to a point where we are going to ask questions we typically ask our guests. One we already asked, which is if you go back, call it 20 years, what would you
Hmm.
say? What would you do differently? And it sounds like you wouldn't do anything differently from a career perspective, but would you do anything differently otherwise if you had that, that hindsight?
I think so. probably wouldn't have stayed at the big firm as long as I did. 2010 was like a particular decision. It was exactly 2 years after the 2008 credit crisis. So
Mm,
my timing there was actually based on a sort of like a retention contract that came with the Bank of America takeover. So,
mm,
I think to myself, if I'd have known in hindsight, the move would have been better to make earlier because it would have given me more freedom to maybe espouse some of the strategies I talk about today and that I live by. So
yeah,
remember, at Merrill Lynch, you are an employee of a firm with a massive research department. So, your job was you were not required to tote the company line in terms of recommendations and where the analysis took you, but it was very much like, that firm's opinion versus someone else's, right? And
right.
became sort of a herd mentality. And I think that maybe leaving a little bit earlier would have helped me develop even more my sort of independent thinking, which is what's objective and what's controllable. I mean, so for the people listening today, I think that you should always take anyone's opinion related to investments with a grain of salt. Yours at Clive Capital, mine as a financial professional included, but concentrate instead on like what is actually objective and like, based on black and white, no opinions. Right.
Yeah, yeah, I like
I
that.
think that's a big thing. I might tell myself to left a little earlier.
Got it. Okay. The other question we always ask our guests is, how do you give back to your community?
So I do a lot of these talks. So that time when I was at Merrill Lynch, the 10 years, I used to joke around that I was kind of I knew the lunchrooms and break rooms of all tech companies, all the office buildings up and down Austin. I had clients primarily Austin, San Antonio, Dallas, Denver, Colorado, and Silicon Valley. And the joke was that I think I'd given presentations in several hundred, maybe close to 1,000 different lunch and break rooms over that particular time. And one of the things I do now is that I get on the phone and I talk about these things, about the basics of what to do right now. Like people always will get into conversations and ask, like, what funds do you like? What particular private investment? What are you seeing people investing in? And I just tell people that look, if you're starting out, it's more about what you're putting, how much you're putting away as a percentage of your salary, how much you're paying, for the investments that you hold inside of that, and then the type of account you put in. And if you optimize those three things, usually the investment part takes care of itself because I, like Warren Buffett, like Ray Dalio, like you, have no idea what's going to happen tomorrow in the stock market.
Right, right. Love that. Okay, well, thank you very much for the great conversation, Henry. How can investors find out more information about you and what you do and get in touch with you?
Sure. I pretty easy to find on LinkedIn. So I think like probably the most known Henry Yoshida. For the company itself, rocketdollar.com. So that's the easiest way to find us. There's a lot of information there, including a phone number where we do answer 5 days a week during business hours. So we have a phone number right there on the homepage at the top line above the fold. And then maybe for me personally, I kind of put some of these funny analogies as it relates to finance. And I did the one about sort of working out. So I do that on Instagram at Fit Finance Henry. So I try to help people understand in a more relatable way. So maybe not the advanced audience that your community represents, but let's say if I were talking to your niece, nephew, or adult son, like, how would you communicate to that person? How would you set them on the right path for, financial success? And I think that that's my way also of giving back is to really give answers that way, because I think that's what is going to create the biggest impact long run for
That's
people.
great. I do have some grown daughters, so I might point them to your Instagram
Yeah.
channel, find out more information.
A
Um,
funny thing since you have your history in Amazon too. So one of the first books I read on investing was in the late 90s, early 2000s. It was The Motley Fool, which, people know
sure.
that site. And they wrote a book on for kids, for teens, like how to invest. And one third of that book is espousing why eBay was going to be the winner over
Oh,
Amazon. So
that is
you might enjoy
hilarious.
that segment. But again, just
Yeah,
goes to show you that the concepts for saving money and paying low cost, they were in there and they were right. Where they were completely wrong was when they tried to predict an investment.
right, right.
No offense to, Mr. Omidar, but
That's right. Okay, well, so we will include your information as well as Rocket Dollar's information in the description of this podcast episode as well. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. Until next time, keep learning to invest for generational wealth.